So the S&P 500 officially entered into a bear market on Monday, and to most people that sounds really scary because bear markets have been known to last for years at times and for prices to go a lot lower. So what's the right thing to do? Is it smart to sell now before prices get a lot lower and to hopefully buy stocks back when they get cheaper? Let's take a close look in this video. So let's learn a lot more about bear markets. If you take a look at the last 72 years, this is from 1950 to where we are today, there have been altogether 11 bear markets, which are marked out in red. As you can see, 1956, 1962, 1966, 1968, 73, and so on and so forth. So 11 bear markets in 72 years, that gives us an average of one bear market every 6.5 years. And of course, it doesn't appear exactly every 6 years. In certain periods, they appear more often. Certain periods, they don't appear for a number of years. In fact, the last bear market we had was in 2020, just 2 years ago. And now we're in another bear market, right? So it's kind of like, coming all at once right now. But over the long run, bear markets are not that common. If you take a look at the bear markets, they could be very short bear markets that decline kind of like about 20% or 30%. You got major bear markets during major recessions. Like, of course, most recently was the subprime mortgage crisis where the markets dropped 57% and the dot-com bust. It was like 20 years ago. It dropped like 50%. But if you average all the bear markets, the average decline of all the bear markets is about 35%. So currently the S&P 500 is down 22%. The NASDAQ is down 33%. So people would say, wow, we could go down a lot more. So intuitively and emotionally, a lot of people feel that, hey, shouldn't I get out now before it drops another 10%? And maybe I could buy it back at a lower price. Especially looking back at the two major crashes, the dot-com crash and the great financial crisis, it would have made sense to get out and get back in at much lower prices. For example, if you take a look at the dot-com crash, you can see that it fell, the S&P fell 50% from peak to the bottom, right? So the moment people realize that, okay, it's a bear market, we close below 20%, get out, right? So avoid the other 30% drop and, I could get back in at a much lower price. Made sense if you look at it this way. Same thing with the subprime mortgage crisis where the S&P fell from the peak to the trough 57%. Again, if you look back at that time, you would say, hey, it would have been good to get out at 20% and I could get back in a lot cheaper. In fact, those of you who have taken my courses, you know that I teach you to identify the major changes in trend using moving averages. For example, back in 2007, when the 50 moving average, the blue line, crossed below the 150 moving average green line, that signaled a change in the long-term trend to a downtrend, and that would have been an exit signal, avoiding the rest of the crash. And then getting back into the markets when the 50 moving average, blue line, crosses back above the 150 moving average, green line, getting back into the markets. And this technique would have worked really well as well during the dot-com crash. Again, 50 moving average crossing below the 150 moving average. Once the moving averages slope down, then you get out and you avoid the rest of the major downtrend. Now, this looks like a change in trend. It is not, because moving averages are still sloping down. You want to wait for the moving averages to be sloping up, for the 50 to cross back above the 150 to get back into the markets and then catch the new uptrend. So this technique works really well for certain bear markets like the dot-com crash, the financial crisis, where it was a protracted long recession and long bear market. But here's the thing. This technique doesn't work all the time. Reason is because these bear markets are the exception and not the norm. In fact, most of the time, bear markets don't last that long. They don't drop 50, 57%. That's really, really rare. In the majority of other bear markets, you find that they drop so fast, but went up so fast that if you wanted to get out, very often you will not be able to get in fast enough. And by the time you want to get in, markets would have been all-time high and you would have missed the run-up. And for example, if you look at 1956, what happened during that time, right? So the moment the market dropped below 20%, and people declare, okay, it's a bear market, and you say, oh my God, let's get out. And the moment you got out, what would have happened? Boom, market would have gone up 56%, and you would have missed those gains because you got out. Another example would be back in 1966. The market dropped, and again, this dotted line represents that 20% level, right? So 20% level drops below there. People say, oh my bear market, oh my God, let's get, it's gonna get worse. Sure, it drops a bit more to 23%, but then boom, it goes up 51.5%. So a lot of people, that's what happens to them. They get out the moment there's a bear market and they don't get a chance to get back in. And the moment they want to get back in, the market runs up so fast that they miss the ride up. 1990, same thing. Market dropped 20%. Again, declared a bear market. People panic and get out. The next thing they know, my God, the market's up 50% and 64%. And most recently, 2 years ago, was the COVID pandemic. And again, that went down and went up so fast that a lot of people who got out never got back in. And so they lost so much money from the crash, but they never got a chance to be there when the market made it all back, right? So, 2 years ago, the market dropped 35%. So again, a lot of people, the moment it dropped 20%, they panicked and they sold. They say, I'll get in lower. But before they could get in, the next thing they knew, the market bounced up and went up 119%. So in many of these cases, you find that even if you used moving averages to get out on the downtrend, to get back in on the uptrend, you end up getting in back at much higher prices, or not even getting in at all. Again, if you take a look at the daily charts, and this was the COVID crash, right? So a lot of people, what happened was it dropped, 20%, they panic, they say bear market, they cut loss. And what happened was by the time you waited for the trend to reverse back up, the 50 to cross back above the 150 and you got back in, you would have gotten back in much higher than you got out. So you miss out on those gains by trying to get in and get out. And again, worse, a lot of people didn't even get back in, right? And the market went up without them. So they ended up losing 20 or 25% and never ever getting it back. Shortly before that, during the trade war crash, same thing. The market dropped exactly 20% here. People panicked and sold, never got back in because the market went up too fast. Or if they waited for the uptrend signal, they got back in on the uptrend, they would have missed a huge amount of gains as well. So here's the bottom line. A lot of people think that, hey, if it's the financial crisis, the dot-com crash, yeah, it made sense to get out and get back in at much lower prices. That's true. But again, those bear markets are very, very rare. The majority of bear markets are like these bear markets over here, where the market goes down and goes up so fast that if you attempt to get out, oftentimes you can't get in fast enough. Or you get in at a much higher price, or you don't even get a chance to get in at all, and you end up losing money and not being there when the market returns everything back to you. This is why research has shown time and again that over the long run, you're better off staying in the market, holding on to good companies than trying to get in and out. Because more often than not, when you try to get in and out, you never get back in, or you get back in at a much worse price because of psychology. So for example, back again in 2020, what happened? When the market dropped, and by the way, this line represents the 20% line. So the moment it dropped below 20%, people said, oh my God, it's a bear market, and they panic and they get out. And they say to themselves, you know what, I'm going to get back in at a lower price. But you never know where's the bottom, right? So if it goes lower, you say it's going to go lower, wait. It goes lower, it's going to go lower, wait, and it bounces up. And what do you say? You don't trust that bounce. I'm going to buy, it's going to go back down again. And then it goes up again, you say, don't trust it. And the next thing you know, you say it's too high to buy it back, and it goes off without you. Has this happened to you before? I know it happens to a lot of people. Same thing over here. This is the 20% mark. This hit exactly 20%. People panicked and sold, said, I'll get in at a lower price. Next thing they knew, it flew up. They never could get back in again. So the cost and the risk of getting out and not being there when the market gains everything back is a far greater risk than just holding it and see it go down temporarily, because it's eventually going to bounce back up. And that's why research has shown time and again that time in the markets is more important than timing the markets. Because if you time the markets and you get it wrong, And it's really easy to get it wrong because it's almost impossible to predict for certain where's the bottom and when it's going to reverse, right? That in the long run, by holding good companies or holding the index, you're going to be much better off than trying to jump in and out, which most of the time will end up worse for most people. I'm sure you've seen this research before, but I'm going to reinforce it once again. So what would have happened to a $10,000 investment in the S&P 500 if you just missed 5 days out of 40-year investment? So from 1980, if you invested into the markets to 2020, that's 40 years, okay? Now, over that 40 years is a total of, let's see, 10,400 weekdays or trading days. And you can see that if you were fully invested in those 40 years, your 10 grand would have grown to about $952,000, about $1 million, right? But out of those 40 years, if you happen to miss 5 of the best days, of the best gaining days, at the end of the period, you would have only $590,000. In other words, you would have 38% less returns than if you just stayed invested. And if you miss the best 10 days out of those 40 years, you would end up with only $425,000 versus $952,000. In other words, you're down 56% less returns. If you miss the best 30 days, you're down 84% from just holding it, right? If you miss the best 50 days, you're down 93%. You might as well have just held cash. So what's the bottom line? The bottom line is that if you think that you can time the market well and get in and get out and beat just holding it, you're betting that you can get in and out without missing just 5 of those days out of 10,400 days. Good luck to that, right? So the fact is this: the majority of the best stock market days where the market had the biggest gains have come in the midst of bear markets. In fact, of the top 10 best gaining days, 6 of those days occurred during the 2000 tech bubble bust and during the 2008 financial crisis. Here's another chart you can look at, and this is what happened to people during the financial crisis back in 2008 and 2009. And you can see what happened to people who panicked during this crash and they say, I'm getting out, I'm holding cash, it's too scary to stay in the markets. And those that got out here and stayed in cash, they would have gotten this return at the end, the one in green, which is like 55 grand, right? And those that got out of the market, exit the market and get back in after 1 year when the uptrend resumed, you can see that they would have ended up with $155,000. But for those who just stayed the course, who just stayed in the markets without timing it, they would have ended up with $238,000 at the end of 2018, which is about 9 years later. All right. So again, majority of people, I can tell you that if you get out during a bear market, hoping to get back in cheaper, most of the people will regret it a year from now. I know, I've seen it many, many times myself over the last 4 bear markets. And that's why, if you take a look at the greatest investors of all time, whether it's Peter Lynch or Charlie Munger or Warren Buffett, none of them got out during bear markets. None of them, not a single one of them. What did they do during bear markets? They held on and they continued buying good companies at undervalued prices, averaging down their positions. And that's what made them the richest people in the world. And like what Peter Lynch said many, many times, he said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than lost in corrections themselves. And remember, if you're holding good companies and the price goes down, even if it drops 20, 30, 40% below your purchase price, you have not lost anything. You have not lost shit. If you don't sell, you don't lose, right? Provided they are good companies, because good companies, you know that the price will always bounce back eventually. Whether it's 3 months from now, 6 months from now, 2 years from now, they will go back eventually. So if you're not forced to sell and you don't sell, it ain't a loss. It's only a loss if you sell. And there's no reason to sell unless you're forced to, right? And no one's forcing you to sell. Just hold on. It will go higher eventually. So is there any reason to sell stocks in a bear market? The answer is yes. There are reasons. There are times when you need to sell stocks. The first reason to sell stocks is only if you're holding stocks of lousy businesses. Remember, when you own a stock, what's a stock? A stock is a piece of a business. So if the underlying business is a lousy business, which means it's losing money, the intrinsic value of the business is declining, then you want to get out, because these are stocks or companies that will never recover. The share price will never bounce back. The only reason the share price was high eventually was because of speculation hype, because of easy money. Now that the easy money is over, there's no free money, these stocks are going to drop or have dropped and they'll never come back. So you want to sell these stocks and take that money and immediately reallocate to stocks of great businesses. So what's a great business? A great business is one where consistently every single year, they are making more and more money. Their profits are increasing. They are generating higher and higher free cash flow. So in other words, every year, the value of the underlying business is actually increasing. The intrinsic value is rising. And the share price is going down even though the business is more valuable. Why? Because the share price in the short term is driven by fear, emotions, and speculation. And for these companies, you've got zero worries. Because if the company is worth more and more every single year, you know the share price is down not for fundamental reasons. The price is down purely for liquidity or technical reasons, that eventually once sentiment shifts, the price is going to go way back to its intrinsic value. So, companies like Microsoft or Alphabet or Adobe, these are companies where you've got zero worries, because share price goes down 20, 30, 40% at times, but the actual business is making more and more money every year. The business is becoming more and more valuable every year. So there's really no loss in these businesses. There's no worries in these businesses. But again, if you hold companies that are losing money or have got no intrinsic value, then you got to get out, right? You got to reallocate during times like these. The second reason to sell stocks is if you are over leveraged. Now, I keep telling my students, never borrow to invest money. Never borrow to invest money. Only invest with money that you have. In fact, only invest with money that you don't need to use in the next few years. These are surplus money. So money that you need to use in the short term, do not invest it in the markets. No, you got to hold it in cash or in short-term bonds, right? So unfortunately, some people, they don't listen. They borrow money to invest, and it's really scary, because if the market drops, you're forced to sell, and you sell at the bottom, and you're going to lose a lot of money, all right? Because the broker gives you a margin call, and you're forced to sell, okay? So if you are over leveraged, which means you have borrowed money to invest, you got to get out. Or I would get out if I were you, right? So that's a reason to get out if you're over leveraged. Because if it keeps going down 20 or 30% more, you are really screwed, okay? Or if you need the cash for something, for an emergency, then you have to get out, right? But if you don't need the cash, you're not over leveraged and you're holding good companies, it makes sense to hold on to it, all right? Now, having said that, if you do need to sell because it's a lousy stock, or you need the cash, or you're over leveraged, you must also know when to sell. So remember that in a bear market, prices don't drop in a straight line. Nothing drops in a straight line like that, right? It falls in a wave pattern. So the market falls like that, wave down, it will always wave up for a while, right? And then wave down again, wave up, wave down, wave up, wave down. It's kind of like the market teases you, makes you happy, kills you, tease you, kill you, tease you, kill you, tease you, kill you, right? It teases you and kills you, right? So if you need to sell for any of these reasons, you want to sell during the rally, right? So you wait for a rally, for a bounce up, a wave up, and you get out at the rally before the next wave down, right? Rally, get out before the next wave down. Now, of course, we don't know the exact top of a rally, so after you sell, it could go a bit higher, and then it plunges back down again. What you never want to do is to never sell at the low of a downtrend. See, most people, the mistake they make is that, right, it's on a downtrend like that, and it drops, and they panic. They say, oh my God, it's too painful. I gotta stop the pain. They get out. The moment they get out, what happens? It goes up, and it goes shit, right? And they thought it's going up, and they get in again. Once they get in again, it goes down again. Okay? So remember, always sell at the high. Always wait for a high point to get out if you need to get out for these reasons. But if you don't need to get out, hold the bastards. Okay, hold the good companies, right? And not only should you hold, but you should continue buying. All right. Again, I'm not giving you specific advice, but I'm saying that as an investor, I continue buying stocks of good companies. Now, people say, but Adam, what if I run out of cash? I don't have unlimited funds. You see, if you tell me that you've run out of cash, that you don't have more funds, then you're not following the first principle of wealth creation. And what's the first principle? The first principle is that in investing is you never put all your money in at once. Never. Investing is not a sprint. It's a marathon that lasts for years and years and years. So investing is something you do regularly, every month, every quarter. And the first principle is that if you want to build wealth, you have to always spend less than you earn. Every single month. Whatever you earn, spend less than that. Save at least 10 or 20% of your salary every month, every quarter. So you always have some savings every month or every quarter. And you slowly put that into work into the market. So you should always have surplus cash every single month or quarter. And if you don't, do your best to reduce your expenses, right? Do your best to live, below your means. Another common question I get would be, so Adam, when do I start adding shares of stocks of, again, only buying good companies, right? Because what if I buy, it goes lower? Again, remember, you can never catch the absolute bottom. No one knows the absolute bottom. Now, of course, one thing you could do is to only buy when there's a confirmed new uptrend. But the trouble is that by the time that happens, you tend to get in at a much higher price. So for example, take a look at Nike. This was during the bear market of 2020 when Nike dropped all the way down. It dropped down about 35% or more, right? And then it went all the way back up as usual because, again, Nike is a great company, right? And if you waited for a change in trend, you said, okay, let's wait for the 50 moving average to cross back above the 150 or for the price to get back above the 200 moving average and you got in here, for example, sure, you could have done that, right? But you would have missed out a lot of these gains and you could have gotten in at a much better price, okay? So the strategy that I use is really simple. I buy in tranches, which means I don't buy at once. I get in one tranche at a time. So for example, I buy 1/4 of what I want to buy, another 1/4. I slowly average in my position. And the first time you enter must be when it's already undervalued. So you have to learn to calculate and know the intrinsic value of every stock that you own. And the intrinsic value must be rising every year. It must be a good business that's making more and more money, right? So for example, if you take a look at Nike, at that time, the intrinsic value was $105 per share. That's the true value of the shares. So you could have entered a first position, for example, at $90 when it was 15% undervalued. So you always want to buy when it's undervalued to get a margin of safety. So once you enter the first time, when's the next time you could enter? Well, rough rule of thumb would be enter when it drops another 10%, right? So if it drops another 10%, to $81, you buy another 1/4 position. And if it drops another 10%, you add another 1/4 position. Drops another 10%, you add the last 1/4 position until you've got a full position, right? And again, did it drop even more than that? Yes, it did. But again, you don't know the absolute bottom, right? But sure enough, if it's a good company, eventually, boom, it's going to go up and you're going to have a great gain. And by adding in stages, your average cost will be somewhere here. And having an average cost somewhere here will give you a pretty good return. And you don't have to, again, buy at the absolute bottom. Finally, remember that bear markets never last. A bear market is kind of like winter. Winter never lasts. winter will always end. And what follows winter? Summer. So don't fret during winter. Don't stay in your house. Go out skiing. Build a snowman. Right? Enjoy winter, because after winter is summer. That's when things will boom again. Same thing. Bear markets don't last. After every bear market, you'll be a bull market. After every bear market, it's a bull market, a bear market, a bull market, a bear market, a bull market, a bear market, a bull market. This has repeated since time memorial, since the beginning of the markets. And every bull market is always a lot bigger in terms of gains than the bear markets. So the bull markets are kind of like the reward that you get for going through the short-term emotional pain of a bear market. And the worst thing that you can do is to suffer the pain of the bear market and not be there to receive the rewards of the bull market. Look at all the 11 bear markets in the last 70 years. It always paid to stay the course, to stick to your investment plan and to not freak out. Let's start with 1956, right? Yeah, market went down 20%, but it went up 56%. 1962, the market went down 29%, went up 62%, and then following that, 82%. 1966, the market went down 23%, went up 51.5%. 1968, the market went down 36%, went up 62%, and then 77%. 1973, this was a big one, right? Market went down 49%, went up 78%, and following that, 132%. 1980, market went down 27%, up 69.5%, and like 80% in the next couple of years. 1987, market dropped 34%, up 66% in 2 years, and up 80% in the following couple of years. 1990, down 20%, up 50%, up 64%. 2000, so this was one of the biggies, right? Dropped 50%, right? But went up 59%, 101%. October 07, we had a 50% drop in 2008, early 2007. In 2009, recovered 106%, following that 219%. And of course, the last bear market dropped 35% and went up 119%. So we're in the 12th bear market of the last 70 years. No one knows exactly how it's going to turn out. But what I can tell you is this: if you stay the course, whatever's a short-term down is gonna be a lot higher when it goes up. So be there when it happens. It tends to reverse at the time when most people least expect it. So I'll see you on the other side. Take care, stay safe, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.